evening, everyone. Welcome you all to this webinar on understanding equity derivatives. And it is our proud pleasure that we have Sir Sunil Gavde with us. So currently he's a freelancer in training and teaching for financial market and commerce courses, but he has a plethora of 19 years of experience with him. And he was last associated with National Stock Exchange as Vice President, Business Development, Currency and Interest Rate Derivatives and Fixed Income Market. So he has handled business development for equity, currency and interest rate derivatives, debt market, and as a relationship manager for institutional clients. His major achievements include that he has worked with regulator, industry bodies, trading members, and market participants, and has been an active member for the introduction of various products and services on exchange, like tri-party repo for corporate bonds, single bond interest, money market futures, cross-currency derivatives, and whatnot. Thank you so much, sir, and we welcome you here to attend and to lead this webinar. And we hope that the candidates will learn from you a lot, and then we can have an interactive discussion, of course. So candidates are requested to please drop in your questions, like in between. If you have any questions, then you can drop in the Q&A box, and we will be addressing to those questions of yours at the very last segment. Over to you, sir.
Okay, thank you, Nancy. Good evening, everybody. So today we are going to discuss about one of the most important and one of the hot topic of the financial market, that is basically equity derivatives. So you must have heard a lot of things about equity derivatives. Somebody will say equity derivatives is very risky. Somebody will say it is very easy and you can earn always a safe return. Somebody will say, no, it is just a speculation. But it is very important before participating or entering in any of the things, especially in a derivatives market, you should understand about that market thoroughly. So today I am giving you the perspective about overall perspective about the derivatives market and why it is important to understand the basic equity derivatives or in general derivatives market, so that it is important for you in future to participate or do many things with related to this equity derivatives or a derivatives market. So my presentation will be more about the derivatives market and then equity derivatives part of that. So let's begin the presentation with derivatives concept. Again, in this 40 minutes, you are not able to understand everything of derivatives. So the idea is why you should basically think about or understanding derivatives is important, and there are various courses, and one of the courses is a NISM e-learning course where you can understand the basic about the derivatives. So derivatives are basically a financial instrument which derive the value from the underlying assets. And that underlying assets can be anything. Means you can have an agriculture commodity, you can have a financial instruments like equity indices, interest rate, foreign exchange, or even you can have a weather also. Means there can be a weather derivatives also. So the scope for a derivatives market is huge. And when you enter in a derivatives market, it is a legal contract. And since it is a legal contract, there are some rights and there are some obligations. And that is why it is very important to understand the derivatives, because when you go in any legal agreement, there will be some rights for you and there are certain obligations, and that's it why it is very important to understand. Now, for defining or the derivatives become or a contract become a eligible derivative contract, there are certain criteria which is defined, like it should be always linked to certain underlying. So underlying should be well defined for the derivatives market, because pricing will happen only based on those underlying. Then it should be always settled in a future date. Then there should not be a full cash flow on a specific trade date, and the trade should be able to settle in a net basis or a gross basis. So you can see that there are various complications when there is a derivatives comes into market, and that's why it is very important to understand the derivatives. So let's see the simple examples of derivatives. I have taken here the 2 examples of derivatives just for an understanding purpose. There are many such examples, and just to give you how a simple exam also can create a lot of complications. So Say for example, there is a wheat farmer and there is a miller. So wheat farmer who will grow the say wheat, and he wants to sell, and his production is going to come after 2 months, and the miller who will require this wheat after 2 months. So they are getting in a contract that after 2 months, wheat farmer will sell 100 kg of wheat to the miller at 1,000 rupees. So it is a future date transaction. There is no initial cash flow. It can be settled on a net basis or a gross basis. So it basically have all the criteria which are required for a derivatives contract. So what wheat farmer has basically does, he has actually reduced his risk about the future pricing of wheat, because he thought that the price of wheat may go down from 1,000 to 9,000 or 8,000. On the other hand, the miller thought that the price of the wheat may go above 10,000, say 11,000, 12,000, and he is not sure whether he will get that 100 kg of wheat also. So he's also basically hedge his risk. So people think, okay, now I have hedged my risk. I don't have any risk when I take a derivatives contract. And now when they come into the contract, they have certain obligations. They have certain rights. Like wheat farmer has an obligation to deliver the wheat at 10,000 rupees. And on the other hand, he has a right to get 10,000 rupees from the miller. So both the people have the certain obligations and certain rights. But it is not that easy that, okay, once I come into a derivative contract, I have reduced my risk. There are certain transactions there where in a derivative contract, you can have a wrong side risk. Now, for example, for a wheat farmer, if suppose tomorrow the price become 12,000 rupees, he has to sell only the miller at a 10,000 rupees. So there is an opportunity loss of him for a 2,000 rupees. On the other hand, if the price become 8,000 rupees, miller still have to buy from the wheat farmer at 10,000 rupees. So he has a loss of 2,000 rupees. So when you are getting in transactions of a derivatives, it is not that every time you will able to cover your 100% risk. And that is why it is very important to understand each and every concept of derivatives when you want to go and participate or understand the in detail or complex derivatives contract. So first understand the basic derivative contract. Now, this is one of the example I have taken. Now, it is not that simple that, okay, trade has done in derivative contracts, so it is over. The settlement part of derivatives also become very, very important. Settlement part means how you are going to settle these transactions, whether you are going to settle this transaction physically or whether there is a cash settled transaction. So that is another important part when it comes to the derivatives. Now, these things are not there in a spot market. In spot market, it is always a physical settlement, means you give money and you get the security. In derivatives, it can happen, it can be a physical settlement. So in physical settlement, whatever will be the underlying price, whether it is 9,000, 10,000, 11,000, you have to give 100 kg, you will get 10,000 rupees. That is the way the transaction will take place. But if it is a cash settled, then there is no actual delivery of wheat. There is a difference which will be received by either wheat farmer or a miller. So for example, if the price is 9,000, then the wheat farmer is in the beneficiary, he will receive 1,000. If it is 11,000, miller is in the beneficiary and he will receive 1,000 rupees. Now, why this settlement is also important? Because each settlement type also carries certain kind of a risk. Now, for example, if this is a cash settled transaction, but miller is in the need of a wheat, then he will get say 1,000 rupees, but he has to go and procure wheat from somebody else. So there might be a certain risk. Or for a farmer, there is a risk he has to go and sell the wheat to someone else. So whether it is a physical settlement, whether it is a cash settlement, both has some advantages, disadvantages. So that is why it is very important to understand not only the derivatives trading, also the settlement part of it. Now we have seen this example of wheat farmer and miller, and we have seen that there are certain other risks also. Now, whether there is any other derivative contract where I can avoid this kind of risk. So let's see this with an example. Now, suppose Mr. X want to buy 1 acre land, which is costing 10 lakh rupees. And he thinks that there might be some infrastructure project on that land. And if that project happens, then the price will increase like anything. But on the other hand, if it does not happen, the price may become zero or worthless. So if what he can do, if he buy like a earlier transaction, he may incur a huge loss if there is no such infrastructure project goes. So what he can do? He can do another kind of derivatives where he will say to the Y that I am not buying a land from you in future. I am buying a right to buy. So here the X is buying a right and not have any obligation to buy after 3 months. So he is buying a right to buy that at a 50,000 rupees a land, sorry, at a 10 lakh rupees a land after 3 months. And for that, he pay upfront fee, which is called a premium. Now, say after 3 months, if actually there was no infrastructure project on that land, X will say, okay, I will not buy land from you because I don't have any obligation, and his loss will be only 50,000. In other case, in earlier case, if his loss might be up to 10 lakh rupees or a 5 lakh or a 6 lakh, depend upon the price of the land. But in this case, only 50,000 rupees. And if the price, say, actually infrastructure project goes and the price become 15 lakh, he will get at a 10 lakh rupees and he has already paid a premium of 50,000. So his actual profit will become 4 lakh 50,000. So you can see that how X, by doing certain other kind of derivative transaction, has reduced his risk. So that is why one solution does not fit for everybody. Similarly, same derivative contract or same derivative transaction may not fit for everybody. Everybody has a different risk, different strategies. So accordingly, he should do a derivative transactions. And for doing that, it is very important to understand the basics of these derivatives, each and every nuances of these derivatives in detail. So if your basics is good, then only you are able to do the complex derivatives transactions. So now what are the different kinds of derivatives? So I have discussed with you 2 derivative transactions. The first example of farmer and a miller is basically an example of forward transactions where they have agreed to do a cash or a physical settlement for an underlying asset for a future date. And it is a customized transaction between the 2 parties. Negotiation happen between them. And it is a OTC. OTC means over the counter. So derivatives contracts can happen over the counter, or can happen on a exchanges, on the stock exchanges. So forward and future are both are same as a concept wise, but only difference is that futures happen on an exchange. And since it is happen on an exchange platform, it is more standardized product, and there is a clearing and settlement happen through the clearing corporations of the exchanges. Then swap transactions are there. Swap transactions are one of the most flexible transactions in derivatives market because you can do swap in any 2 underlying, any 2 products for multiple periods. So swap is one of the most flexible derivatives available in the market, and mostly swaps are traded in the OTC market. And the last one is the option, which is the more complex product where basically you buy a right to buy or purchase, or buy a right to sell a underlying security in a future date at a specific price. Okay, so when you are buying a right to buy, it is called call option. When you are buying a right to sell, it is called put option. So the example which we have seen in the earlier slide of X and Y, it is a option transactions where the X has bought a right to buy in the future. So he has done a call option. So you can see that by doing that, he has no obligation but has certain right. But for that, he is paying premium. And options are basically a derivatives which trade both on over the counter as well as on the exchanges. So these are the various kinds of derivatives which are available in the market. And the next one is now, what are the underlyings? So major underlying. So this I am mainly talking from the Indian point of view. So in case of equity, we have equity derivatives in equity shares, equity ETFs, and equity indices. So in India, we have a futures and options, and both are traded on the exchange. So we have a exchange traded equity futures and equity options. Similarly, we have FX futures and foreign currency options, interest rate futures and options, which are traded on the exchange. Then we have a commodity futures and options. Credit, we have only credit default swap, which is trading over the counter market. So e equity derivatives are only traded on the exchanges. We don't have a OTC market for equity trading. Others are also traded in the over the counter market. So for example, interest rate and currencies are most active on the over the counter market. But equity derivatives are more, it is there only on the derivatives market, and it is the most active contracts. And that's why it was always say, okay, first start with the equity derivatives. If you want to understand the derivatives market, first understand the derivative concept, and then first understand the equity concept. Why equity derivatives? Equity derivatives is comparatively easy to understand, because as underlying change, though the concept for all the underlyings remain same, whether it is a future or a options or a forward, but then other nuances like pricing, trading strategies may change. For example, when you trade equity, you have to only think about the equity shares. But when you are trading currency, there are two currency pairs, USD and INR. Say, for example, USD INR you are trading. So you have to think about two currency pairs, and according to the pricing will happen. When you are trading interest rate, say for government securities, there is always interest inbuilt in those security, or a fixed income is inbuilt. So you have to think from that point of view and do the pricing. So as underlying change, the pricing and the other things may change, but the concept related to future and options will remain same, whether irrespective of the underlying asset. So that is why it is first important to learn what is derivatives, and then start with the equity derivatives. And from the Indian perspective, equity derivatives is the most liquid, and we will come to that subsequently. So this is basically about the various derivatives instruments. Now, this is again very important slide as far as derivatives are concerned. So when you are talking about the spot market, you only think about buying a security or selling a security. So you should know, okay, I want to buy XYZ company. So you will see what is the perspective of that company, and you just do buy and sell. This is the price, this is the quantity, and that's it. But when you do a derivative transactions, there are many things you have to see. What is the underlying assets? What is the current spot price is going on? What is the future price if you are trading in a future market? What is the contract cycle, whether it is a weekly contract, when it is a expiry, means when the contract is expiring, today after 1 week or a 2 week or a 1 month or a 5 month. What is the contract size? Because it doesn't trade in a lot of ones. So whether I have to buy 5 lakh lot or a 10 lakh lot or a 5,000 quantity at one go, and so on. What is the volatility in the market? How the payoffs happens for future? What is the payoff for a put option? What is the payoff if I buy? If the call option, what will be the payoff? Because payoff is not linear in case of option. So it is a non-linear. What are the different option types? So in futures, future prices become important. In case of option, option premium become important. So how the option premium is calculated? What are the options Greeks? You should have to understand those option Greeks. Then what is the strike price? What is the final settlement type? Whether it is a physical settlement or whether it is a cash settlement. How the final settlement price is derived? Because say for an example of that wheat and Miller, which price they will consider on the expiry? There might be a price in the wholesale market. There might be a price in the retail market. There might be a 3 kinds of graded of wheats, grade 1, grade 2, grade 3. So lot of complications. So similarly in derivatives market also, whether I should take a last traded price or I should take only X exchange price, or I should take Y exchange price, or there will be a weighted average price of last half an hour. How this final settlement price will be determined? Then what is a position, means whether when I take a buy future, what is my position? When I do a buy put options, what is my positions? What is the overall open interest in the market? And there are many more. Means I have written here some few important terminologies of derivatives contracts, but there are many terminologies like what is a put and call options ratio and option chain, etc., and so and so on. So it is, you can see that I have just written here 10 or 15 terminology, and there are still many terminologies are not here. So it is very important to understand all these terminologies when somebody wants to understand the derivatives market or a derivatives contract. So it is very important to start with the basic and simple derivatives and then move to the complex derivatives. Now, this is again a very important slide as far as derivatives is concerned. So people thinks derivatives is only a speculation, or people thinks derivatives means only a hedging or a risk management, but it is not like that case. There are various purposes for which people can use derivatives. So main is for a hedging or a risk management. Another is for a leverage or speculations, means you can do buy and sell. So instead of speculating in the underlying market, you can speculate in this. There is a arbitrage can be done with the help of derivatives market. So if there is a price difference between the two different market, you can basically take benefit of that and you can earn profit without taking any risk. That is called arbitrage. So there are again many things. You can have spot versus future arbitrage, future versus options, spot versus options, within options, options spot, future, in future spot, securities lending and borrowing, and so on. So there are various strategies you can do with the help of derivatives. Another is a price stability. If you don't know, most of the central banks in India as well as in India, Reserve Bank of India, and out of India, other in world, various central banks use derivatives market to stabilize the price of their currencies. So in India, RBI use derivatives market to stabilize the price of USD. So it is not only that people use for a speculative purpose for again to discovering price. Means you know the future price. Sometimes from future price you get the idea about the spot prices. So there are various purposes of a derivatives market, and if you want to understand this purpose, first understand the derivatives in detail, make your basic rights, and then move to these various purposes for which derivatives contract can be used by the market participants. Again, very important, because we have seen what are the uses of derivatives, what are the different terminologies of derivatives. So no contract is a risk free. We have seen the example of farmer and miller, and we have seen that there is a other side risk for both of them. So this is one of the risks, basically is a market risk. Then you will say, okay, oh, with options I can avoid those kind of risks. But again, there is a risk also when you buy options, because you may lose all your premium. So you have to worry about all those things. So there is a market risk, there is a liquidity risk. Liquidity risk means if you want to close your contract, you may not find a counterparty. You will not execute it. You're not able to execute your derivatives contract. Now, the risk of counterparty risk in case of a OTC contract, it is possible that, okay, Miller is not decided that he will not fulfill his transaction. Then it is become a counterparty risk. So those kinds of risks easily get avoided by trading on a participating on the exchange traded. So by trading on exchange, you mostly avoid the risk of counterparty or settlement related risk, but other risks are always there. So leverage risk means when you are doing a getting a benefit profit in multiple times, means by investing 1 lakh rupees, you get a basically position of 10 lakh. That is called leverage. So your profit become 10 times. So similarly, your loss will also become 10 times. So those kind of risks. There is a regulatory risk, means some of the parties are not allowed to participate in a derivatives contract, or they are to allowed for a limited purpose. Then there are restrictions on how much positions they can take. I have spoken now, open interest or open position. So how much positions somebody can take. So those kinds of risks are also there. So it is very important to understand each and every risk. Now, here I am not going to able to provide in detail everything, because this is just to make you understand okay, why it is very important to learn derivatives from the basics. So that's why all these risk you should able to understand, because that only then only you are able to take a proper decision while participating in derivatives market. And where you can learn all these things, so as we are saying, there is a NISM e-learning course now. Now there are everything is online, so there is an e-learning course where in a small course you are able to learn from the basics of the derivatives contract and mainly focusing on a equity derivatives contract. And now why equity derivatives contract in India? So equity derivatives contract is basically a exchange traded contract. It is the most active and liquid derivatives contracts available in India. Even if you compare with the OTC market also, so even OTC market of currency will be lower than the equity derivatives contract in India. It is screen-based anonymous order trading system. So sitting at home, people can trade in equity derivatives contract. We have one of the world's best infrastructure for trading in equity derivatives contract. Whether you trade any of the exchange, we have best infrastructure while for trading, for clearing, settlement, risk management, and there is 100% guaranteed settlement. So as at least your counterparty risk, settlement related risks are get avoided once you trade through this exchange traded derivatives. So this is the most liquid and contract which is available, and you have a multiple products. So there are around 175 plus securities on which equity derivatives are available. There are various indices on which equity derivatives are available. There are various equity ETFs are there on which equity derivatives are available. And why I'm saying liquid, one of the prime exchange of India, which is a national stock exchange, is the number one in terms of contract traded in the derivatives contract. And I think for in I think they are in top 3-4 in various index derivatives contract or a single futures contract. They are in top 5 in most of these things. So this is the way our derivatives market is so much liquidity. And why there is so much liquidity? Because of first the best infrastructure, and another is a different category of participants. So category of participants, I can say there is a speculators also, arbitragers also, and hedgers also. So you can say that way category, or there is a retail, I will not say retail participation, but there is, I can say non-individual, high net worth individual investors or corporates, they are participating. Your proprietor trading members are participating. Your financial institutions are participating. Your foreign portfolio investors are also participating. So there is a mix of everybody in this market, and that's why this market has become very, very important. And it has a huge growth. Means I think in last 10 years, it has increased more than 40% of in terms of CAGR. So that is the growth available in equity derivatives market. So there are huge opportunities also in this derivatives market, and as far as equity derivatives is concerned, and that's why it is important to first always start with the equity derivatives, and it is easy to understand as compared to complex commodity or a currency or a interest rate markets. So anybody wants to learn about the derivatives, they should always first start with the equity derivatives. So I've just taken one example. Means it is not a just example that company is having 1,000 crore shares, and he wants to hold for next 3 months. So what he can do if he is not have certain about the market conditions? So he has a lot of option. So how he can basically hedge his risk? So he can sell share today and invest money in money market instrument, which is a risk-free instrument, uh, or he can sell future and hedge his risk, or he can buy put option, because buying put option will give him the right to sell at a specific price, say at a strike price of 1,050. Or if you want to earn certain alpha on this 1 crore shares, so he can do a sell call option. So this is not a hedging strategy, or he will remain status quo. So last two are not the hedging strategies. They are just, I am giving various strategies which can be available to the market participant to give you an idea. Okay, derivatives is not a simple that I will just buy or sell a future, or I will buy or sell a put or a call options. And why it is important? As I said in earlier of one of my slides, that when you do basically derivatives terminology, I said that it is very important to understand the various scenarios and the various payoffs of those scenarios. So just for your feeling, I have given one example of these scenarios, that okay, what will happen if you have sell share today and invest in the money market instrument. So if the price is anything, it is not going to change your life. You are going to get 1,012 rupees 50 paisa. In option 2, what is going to happen if you sell future? Again, you will fix price at 1,025. Now in option 3, what is going to happen? You have buy put option. So again, the price is less, you are not losing. And even the price is getting high, so you are reduce your wrong way risk when you are buy put option. Similarly, in case of option 4, which is not a hedging strategy, but it is a alpha generating strategy. So what will happen in that? If you decided to remain status quo, what will happen in that? So if the price is 900, you will get 900. If the price is 1,200, you will get 1,200. So you will see that every place is some or other things is better than the other things. So this is basically a scenario building. So none of the single your strategy is always better than the other strategy. In some case, first strategy might give you better return. In other case, another strategy. In some cases, the third strategy. And even in some case, the status quo will also give you the best strategy. So that is the idea, and how these things you will understand. Now, this Excel you may not understand, because this is for understanding this, you should first learn what is future, what is options, what are the payoffs of futures, what are the payoffs of options, and so forth and so on. So just to give you understand why it is important to understand the basics and the payoffs, and then you can build all these scenarios. So this is one of the slide on the derivatives contract in the whole world. And you can see which is the derivatives is contributing the highest. Equity derivatives. The contribution from equity derivatives for last year is 68%. I am talking about exchange traded. In OTC market, interest rate derivative is the most liquid contract. And overall also the interest rate derivatives may be the most liquid contracts, followed by the currency or commodity. But exchange traded currency is the most liquid. And in India is also the same case. And you see the growth. This growth of 2020 or 2021 is 48% all across the world. And India is also, there is no different case. Our growth is, as I said, in last 10 years, it is more than 40% in equity derivatives. So that's why the equity derivatives are one of the most liquid and one of the most important and growing market as far as India is concerned. Now, I have spoken all about this equity derivatives, this terminology, why it is important. Now, where you can learn about this basic in equity derivatives. So if you want to learn about this basic equity derivatives, then NISM provide this e-learning course for basics of equity derivatives or understanding in equity derivatives. It is a small course of around 4 hours approximately, and it is online. You can start now and you can learn anywhere within the 30 days. It is a very well drafted presentation in very simple terms. It is easy to understand. You get a certificate after the completion of this course, and the course fee is also very, very minimum, only 1,200 plus applicable taxes. And this course basically a simple course. It makes your basically understanding about the derivatives market, because as I said, the concept is going to remain same for everybody, and more focusing on equity derivatives. What are the different types of derivatives in India, especially in equity derivatives? Then what are you want to understand about the option pricing, which are very complex, and then risk management. As I said, there are many risks. So how to manage those risks? So risk management of derivatives. So all these things you are going to learn in this equity derivatives e-learning course. So this is basically a course coverage, and to whom it is suitable, basically anybody who wants to come in the intermediate in equity derivatives market, or a student who want to do career in the finance. And now if you want to do a career in finance, it is very important to learn derivatives market, because see, you will say, okay, I will go in a bank, why I require derivatives? Even though you go in bank, you require the derivatives. If you go in tomorrow treasury, you will have currency derivatives and interest rate derivatives. If you go tomorrow in mutual fund industry, there is a equity derivatives or a interest rate derivatives, even now currency derivatives. So you can go anywhere. There will be, which is related to finance, there will be certain financial risk, and to avoid those financial risks, derivatives is very, very become important. So that's why it is very important to learn about this derivatives market. And then a investor who wants to learn more about the complex derivatives, wants to trade in the derivatives market, first they should understand the derivatives and simple derivatives, and then they can go into the complex things. So for them also, for those beginners also, this is a very good course to learn. And these are the various other courses of NISM which is available. So it is a different course on different products specific, like currency derivatives, interest rate derivatives. So it is a specific to a product. Then it is specific to the industry, like mutual fund related things, then advisory related, then operation of the markets. Like if you want to learn about the broking operations, you want to learn about depository operations. So then there are courses on operations. Then there are certain courses on compliance also, because compliance is now very, very important if you go any of them. So these are the various courses are available. So all this information is also available on the NISM website, and you can go and register, and you can basically get registered for any of the courses, or this basically a equity derivatives e-learning course. So that's it from my side. So now we are open for question and answers.
Thank you so much, sir. Thank you for the session. It was indeed a great one. And we have a great deal of questions to answer. So I don't know how much we'll be able to take these questions, because this is one of the most curated topics that we have taken today. So I hope we can answer as much as we can.
Yes.
So let's start with the questions that we have. So let me see. First one is, I believe, well answered, that which NISM module exam is needed to work in equity derivatives. So it is series 8 that is required, and it was also there in the PPT. So, so there is one question, that will the price of derivative be based on supply and demand forces of the market, based on buy and sell orders for that particular contract, or it is based on value of the underlying asset?
So it is basically a mix of everything, because if any price is basically determined based on the market demand and supply, but the underlying prices also become very, very important. So actually one of the eligibility criteria, I think, of this derivative contract, people are said that your future price should always link to the underlying price. So it should not happen that, say, there is a share, company's XYZ share in the spot market is increasing, continuously, but on the other hand, the future price is going down. So it will not happen. If the spot market is increasing, then the future price has to be increased. So there will be always a correlation with the underlying price. So that is also become important. Then demand and supply is also very important. So it is mix of everything. But mainly it is determined, it will be logically should be determined the spot price or the underlying price.
So just coming out with the next question as well.
So if anybody who has asked this question, if you want to understand more about this, then it is very important that you should basically register for these courses, because you are going to learn about all these things in this course only. So that will be my suggestion for them.
So there is one more question that I think we should address it. So the question says that are the settlements happening in small spot market physically? So the question says
market,
that
the physical settlement will always happen. Suppose I buy a share of a company A, then on a settlement date, I have to give the money and I will get the share in the spot market. But derivatives market, the transaction can be cash settled or it can be physically settled. Now, for example, in India, all index derivatives are settled through a cash settlement, but all equity shares, means stock futures and options, are settled in a physical settlement. So when on expiry, when there is a final settlement happen, you will get the basically physical shares, or you have to deliver a physical share, depends upon what is your positions. Now you are talking about spot market. If you are doing intraday trading and it is basically a netting wala security, then it is net settlement, then there is no delivery will be happen. But there you are doing buying 10 shares and selling the 10 share of the same security. That is why there is no delivery. But if you are only buy 10 shares, then you have to give money and receive the shares in spot market.
So one more question that we can take is underlying does affect the price of its derivatives, but is it true the other way around as well? So the question says that can derivative affect the price of the underlying asset?
Yes, it is possible because of the liquidity in derivatives market. As I said, in the purpose of derivatives market, I said that derivatives market sometimes help in determining the price of the under spot price market also. And even I said that many times the central banks or regulator use derivatives transactions or say derivatives for basically to stabilize the price of the underlying.
Okay, I think this is the last question that we can take, and it says that why are equity derivatives not available for all securities?
See, because derivatives contracts are very risky contracts, and as I said, okay, their prices are purely depend upon depends upon the underlying price. So that's why it is very important that underlying market should also be very liquid market. So there are certain liquidity criteria and there are different criteria which is specified by SEBI. So based on that, only those securities become eligible in the derivatives market. Otherwise, it is possible that the price may get manipulated in the derivatives market, because in underlying market, when you trade, you should have the full money with you, but in derivatives market, it is just a leverage. So that's why the case that all securities are not available in the equity market. So again, all these information or these questions answer you will get when you basically register for these courses, because in that they will tell you, okay, what is a criteria for having a security in the derivatives market and all other stuffs.
Thank you so much, sir. It was indeed a great session, and thank you so much for taking time for us. And I know we all know that you have a very busy schedule.
Yeah.
And just let me tell you, this is one of the most successful webinars that we have had with maximum number of participation. So I think we will need another one also for that.
Okay. Thank you.
Thank you so much, sir. Thank you.
Thank you.
Thank you so much, everyone.